July 2025. An internal memo from Porsche's CEO, Oliver Blume, leaks to the press. The tone is unusual, and the message brutally direct. Our business model, which has served us well for many years, no longer works. And the consequences? They're hitting us harder than almost any other manufacturer. What happened? Less than 5 years ago, Porsche was the shining example of innovation done right. A record-breaking initial public offering, a groundbreaking electric lineup, rising sales. But somewhere along the way, something went wrong. The numbers began to slip, customers started to complain, and the brand once synonymous with control lost its grip. What went wrong inside one of the world's most admired car companies? And how did almost no one see it coming? It's 2019. While most sports car brands are still hesitating about going electric, Porsche does something no one expected. They unveil the Taycan, not as a concept car, not as a futuristic dream, but as the next step in their legacy. The specs were impressive: insane acceleration, lightning-fast charging, and a design that declared, "This isn't a science experiment. This is a Porsche." Only this time, there were no fuel vapors or roaring engines. It was fully electric. And that was just the beginning. CEO Oliver Blume revealed his grand plan. By 2025, half of all new Porsches would be electric. And by 2030, over 80%. To outsiders, it sounded like smart policy. Environmental laws, sustainability pressure, Tesla shaking up the market, it all seemed like the way forward. But behind the scenes, something bigger was at play. Porsche was deeply entangled with its parent company, Volkswagen. And Volkswagen, still reeling from the global diesel scandal, was desperate to clean up its image. So a new strategy was born: massive electrification, multi-billion investments, and Porsche as the green flagship. The 2022 IPO cemented that confidence. With a market value of nearly $85 billion, it became one of the largest public offerings in European history. The market believed. The fans, for now, still did too. The Taycan sold well, especially for a newcomer, from 20,000 to 40,000 units per year in just a few seasons. It was even closing in on Porsche's sacred icon, the 911. The strategy seemed to be working. Blume was even promoted to the top role at Volkswagen. Porsche became the example, the textbook case of success. But somewhere, buried under all the strategies, spreadsheets, and green ambitions, something started to feel wrong. Not with the technology, not with the sales, but with the soul of the brand. On the surface, everything still seemed smooth. The Taycan was selling well, the stock price was solid, and Porsche had successfully positioned itself as an electric pioneer. But within the fan base, tension was brewing, and not because the cars drove badly, quite the opposite. The Taycan was fast, the tech was impressive, and the finish? Classic Porsche. Sleek, solid, premium. But once you stepped inside, something was missing. Something you couldn't find in a spreadsheet. No figure, no specification, feeling. The Taycan felt quiet. Not luxury quiet, but empty quiet. For the first time, customers started asking, is this still a Porsche? The adrenaline, the roar of the engine, the mechanical sense of control, all replaced by silence and screens. Even EV fans couldn't quite explain it. The Taycan had everything, except character. Meanwhile, Porsche kept doubling down on innovation. Faster charging times, more digital features, even smarter drivetrains. But no matter how advanced, it seemed they had stopped asking one simple question: what actually makes our customers happy? Because where Tesla created a new segment, appealing to tech lovers, gadget enthusiasts, and efficiency seekers, Porsche tried to convert its loyal sports car fans, not with emotion, but with specs. And that mistake, that one blind spot in their strategy, would eventually grow into a gap big enough to swallow the entire brand. But behind that growing divide, another tension was building. Inside Porsche itself, Volkswagen had committed over $100 billion to electrification, and Porsche, as its crown jewel, was expected to deliver results fast. The problem? Every electric vehicle was far more expensive to build than anyone had projected. Battery prices surged, logistics costs spiked, and margins began to erode long before production could scale. Inside Stuttgart, engineers warned that the numbers didn't add up. They loved the technology, but not the math. Internal reports quietly admitted that EV profit margins could fall below 10% before 2025. Yet the marketing department kept pushing the same message. The future is electric, and Porsche leads it. By 2023, the Taycan's reputation had become both a symbol of progress and a growing burden. Investors wanted constant growth. Customers wanted the old Porsche back. And between those two expectations, the financial and the emotional, the company's perfect balance began to crack. What started as occasional feedback soon turned into a pattern. On forums, in reviews, and under YouTube videos, complaints from Taycan owners began to pile up. The criticism wasn't about performance or design, but about everyday usability. Some owners reported doors that didn't always respond. Others saw the infotainment system randomly shut down. Climate control behaved erratically, and navigation or CarPlay would sometimes just stop working. In many cases, repairs took weeks, even months. Not because the issues were complex, but because parts were unavailable or software updates were delayed. Local service centers often lacked the tools or expertise to diagnose the problems properly. Without direct support from Germany, the process slowed to a crawl. Then came another blow. Resale values collapsed. For a relatively new Taycan, depreciation of up to 50% within a few years wasn't unusual. On the used market, demand lagged far behind. Buyers grew hesitant, put off by stories of poor service options and unreliable software. Soon, the numbers confirmed the trend. In 2024, Taycan sales dropped by nearly half, from over 40,000 units per year to just above 20,000. Porsche's operating margin fell from 18% to around 11%. Ironically, the traditional models, the 911 and 718, remained stable, even improving in performance and sales. Despite Porsche's clear strategic shift toward electric, the appetite for combustion engines refused to die. What was once presented as technological progress was now clashing with the expectations of loyal customers, not because of the concept itself, but because of its execution and support. By mid-2024, the situation had become impossible to ignore. The Taycan, once launched as Porsche's electric flagship, was now showing a sharp and unexpected decline. Where the model had once been heading toward 50,000 units sold, annual sales dropped to just above 20,000. This fall wasn't only due to weaker demand, but also to production issues and long-lasting service disruptions. Then came a deeper, more complex problem: value retention. The Taycan was depreciating at an alarming rate. A model that had sold new for $180,000 was sometimes losing more than 50% of its value within 3 years. For potential buyers, that was a clear financial red flag, hurting both resale and leasing markets. Technically, the model was under pressure too. In 2025, Porsche announced a global recall affecting more than 27,000 Taycans due to a potential short-circuit risk in the battery pack. Owners were advised to temporarily limit charging to 80%. At the same time, margins continued to shrink. Where Porsche had posted an 18% operating margin in 2023, by 2024, it had fallen to around 10 to 11%. In absolute numbers, the picture was even starker. Profits plunged from $8.2 billion in 2023 to $3.6 billion in 2025. The company's market value dropped by more than 60% from its peak. The pressure on CEO Oliver Blume was mounting. In the summer of 2025, an internal memo surfaced. Blume admitted that the existing business model no longer worked. He pointed to the high cost of electrification, the complex market dynamics, and the need to return to profitable models. The strategy was adjusted. Porsche would pause the expansion of its electric lineup, making room for new plug-in hybrids and combustion engine models. Nearly 4,000 jobs would be cut by 2029. What began as an ambitious acceleration toward the future had now turned into a fundamental rethinking of Porsche's entire brand identity. On paper, the strategy made perfect sense. The Taycan delivered strong performance, the market was shifting toward electric, and Porsche had the technology and resources to make that transition possible. Yet somehow, it wasn't enough. Not because of flaws in engineering or build quality, but because of something far less tangible: the brand's relationship with its drivers. Porsche had always played a specific role in the automotive world, not just as a maker of fast cars, but as a brand that embodied a unique driving experience, a direct connection between human and machine. With the move toward electric, that focus began to shift. Communication and product development started revolving around performance, innovation, and technological superiority. That aligned perfectly with industry trends, but not necessarily with the expectations of Porsche's loyal customers. While other brands managed to attract new audiences with fresh electric identities, Porsche tried to bring its longtime fans along for the ride, without first confirming whether those fans even wanted to go. The consequences only became visible once customer behavior began to change, not abruptly, but gradually. Interest in new models declined. Demand for traditional models stayed high. Resale values dropped, while maintenance remained complex and expensive. Looking back, it wasn't really a failed electrification strategy. It was a loss of alignment between the brand and its users. A brand's position isn't defined solely by what it can do technically, but by what its customers expect and recognize. And when those two drift apart, a space opens up, first for doubt, and eventually for hesitation. In the second half of 2025, the consequences of Porsche's strategy become unmistakably clear. Profits have fallen from over $8 billion to just above $3.5 billion. Operating margins have dropped to levels the brand hasn't seen in years. The stock price now sits at its lowest point since the IPO. At the same time, the company is undergoing a major reorganization. Nearly 4,000 jobs will be cut over the next few years. The model lineup is being restructured, making more room for plug-in hybrids and combustion engine vehicles. Electrification remains a key focus, but it's no longer the only focus. The new priority is profitability in the short and medium term. Even the communication has changed tone. From now on, the degree of electrification will be guided by customer demand, not by fixed percentages or rigid timelines. The question is whether this course correction will be enough to rebuild trust. Porsche isn't the only brand facing hard choices in this transitional era. On this channel, you'll find more stories of companies forced to reinvent themselves. Feel free to explore the other videos, and see you soon.